Hello, I'm Mark Lowdy. If you're looking to invest in property, there are many choices on the Singapore market. Quite apart from the HDB flat or the private condominium that you might already own, there are also listed ways of getting into the property market. In other words, buying into companies that own properties. One of those companies is CapitaMalls Asia, whose Deputy Chief Executive, Simon Ho, is with me. Hi there, Simon. Good to see you.
Hi, Mark. Morning.
You're part of the CapitaLand Group. And first of all, I wanted to bring up the organization chart of CapitaMalls Asia, because this is actually a very sophisticated chart. The company that you co-run as Deputy CEO has so many other parts of the business. So can you just talk us through actually all of the various parts of the business that people can get exposure to by buying the units of your company?
Right. First, you're right, Mark. We are part of the CapitaLand family of companies. CapitaLand is a pretty big company, and what is its exposure to different parts of businesses. So within CapitaLand, we are the shopping center arm. CapitaMalls Asia does nothing but shopping centers. We are separately listed. CapitaLand owns 65.5% of us. Right. Within our group, we also have other listed entities. For example, I think a lot of Singaporeans will be familiar with CapitaMall Trust, because this was the first REIT that was listed in Singapore 10 years ago.
Yes.
So it owns all the familiar shopping centers in Singapore: Tampines Mall, Junction A, Plaza Singapore, and so on. So that's 27% owned by CapitaMalls Asia. And we also have another listed entity called Capital Retail China Trust that owns China Malls. We own 40% of this vehicle. And in Malaysia, we have another listed entity called CapitaMalls Malaysia Trust, which owns our Malaysian assets.
Yes. So I guess that's the first point for you to help us understand a little bit better. Who would buy into CapitaMalls Asia, the overarching umbrella company, shall we say, rather than the individual REITs that you've just mentioned?
Right. I think the way investors should look at us would be CapitaMalls Asia would be the developer. The entity that they should look at will be one that takes raw land, designs, develops, builds a shopping mall, and operates it. So we are the developer, owner, and manager of a mall. And usually, once a mall stabilizes after maybe 3 to 4 years, we will then, in a way, put it into a REIT. And the REIT itself have different investors. They are investors who want stability, who wants at least the ability to see that the income coming in from the malls are very stable, so less risky. And people who want dividend yields, regular payouts, I think they will probably look at our REITs. But for investors who have a little bit higher risk appetite, may perhaps want to invest in CapitaMalls Asia. And the other thing that maybe I can point out would be something like CapitaMall Trust, fairly Singapore-centric. So if you are Singapore investors who know Singapore very well, you know the malls that CapitaMall Trust has, I think you yourself can have a feel whether the REIT is doing well or not. For Capital Retail China, it's more China malls. CapitaMalls Asia itself, whoever is investing inside CapitaMalls Asia will need to know that we are in 5 countries. We are in Singapore, we are in Japan, India, China, and Malaysia.
And that's again borne out from the org chart, because again there's obviously a lot more than just those 3 listed vehicles. There's I'd say probably about a dozen, possibly even more. So can you help us understand what these other companies in this org chart are?
Sure. For example, we have quite a number of private funds. In China itself, right now we have 58 malls, and I think China is a country that we can grow significantly. And one of the, I would say, constraints in trying to grow quickly will be capital. And I suppose one of our ways is to then set up private funds where we get like-minded investors together with us with a long-term view. And by bringing these capital partners on board, we are then able to scale up faster. So we do we have actually 4 private funds set up in China already. 3 development funds, 1 incubator fund.
Okay, and again we see that in the middle here under the word China. So overall, you're a shopping centre, as you say. You build, you operate, and you own the shopping malls. What then is the outlook for this business in view of the fact that, right now there's so much dour news about people in Europe not spending as much anymore. China is facing a slowdown.
Right.
How's that impacting you?
Right. If you look at the countries that we are invested in, it's all in Asia. And I think for the shopping mall business, there's no better place to be than in Asia now. Young population, everyone willing to consume. In places like China, I think the wealth is going to grow. And yet there are very few opportunities or places where people can spend. And as the Chinese government encourages local consumption, they will have to find avenues, and that natural avenue is shopping malls. And if you ask me, lots of opportunities in places like China, India, huge population, young population, upward mobile population, all waiting to consume, and we are in the right place at the right time, I think.
Yeah. Still, people have said in the past that Asians tend to be quite thrifty. They prefer to save, put the money under the mattress, as it were, than to spend it. So the fact that the Chinese are trying to encourage this consumption is in fact not just a fiscal stimulus issue, it's a cultural issue in a sense, isn't it?
Sure.
How much of an impact do you think the government's had?
Well, if you look at retail sales in China over the past few years, I think it's growing at double-digit growth. This year's forecast for retail sales in China is 16 to 17%. Right, 16 to 70%. It comes from the Ministry of Commerce Research Center, so a fairly independent view. And this is borne out and based on our observation in our malls in China. I think it's real numbers. If you look at the results announced by China Retail Trust recently, they renewed something like 221 leases, and they had a 15.2% increase in rent over the past rent. And we can only have this kind of increase if the tenant sales are very strong. And what we have observed in the first half in our malls in China, I think the total growth at the tenants level, at the shop level, is about 11.6%. If you take away first-tier cities, you'll find that it goes up to 15.9%. It means that even the second and third-tier cities are also, the people in those second and third-tier cities are also consuming, they're buying, they're spending.
But I guess the important nugget to take away from that, I think what I'm hearing you say is that you're able to grow in line with growth in retail sales, which is an important distinction because presumably there could be some slippage.
Sure.
Just because retail sales are up 20% doesn't mean that your earnings are going to be up 20%. Is that right?
Yeah, but I think, thanks Mark for that. It gives me a chance to clarify. I think for CapitaMalls Asia, we own the malls. Our income comes from rental. Right, but if you want to sustain your business, tenants must do well when they come into our mall, right? It's only when tenants do very good business and good sales and their sales are growing, that's when we can then, I would say, extract a higher rental from them. Now, if we are somebody who just charge high rentals and our tenants are all not doing well, well, this game will not be sustainable, right? They'll pack up after a while and we have to find a new tenant. That kind of scenario is not good for us, right? The other indicator maybe I can offer, we look at the occupancy of all our malls. In Singapore, we are 99% full. We have quite a lot of malls in Singapore, 99% occupancy. In China, we are about 97% occupied in all our malls. In Malaysia, 98%. In India, we are 99%, and the lowest in Japan, we are 95%. So very, very strong occupancy. Now, we are able to have this kind of occupancy mainly because I think tenants, first we have a good tenants network. Tenants know us, we know them. We have more than 10,000 leases, so we are pretty plugged in. Second thing, tenants want to come in our malls because our malls attract very strong footfalls because we know how to run our malls well, we have good A&P activities and so on. And the other thing that I think it's our hallmark is we are very active managers. We manage our malls very actively, constantly refreshing our tenancy mix, constantly doing asset enhancement, and that keeps the mall fresh, and relevant to the shoppers. I think these are all the things that we do that will attract good quality tenants into our mall. If they do better business, we can get higher rent. It's a simple correlation. Yes.
Now, a lot of stability, I guess, that you've talked about is tied to the fact that the tenants are with you for some years. Right. And in the real estate business, there's the so-called weighted average lease to expiry, WALE for short, has nothing to do with fishing and everything to do with making sure that that continuity of cash flow is there.
Right.
So when people look at REITs and they see a weighted average lease to expiry of 4 years or 5 years or 8 years, what should people, investors that is, what should they do with that number? How do they interpret that number that they get? And by the way, what is your weighted average lease to expiry?
Right. Actually, for retail, could be slightly different from other asset class. Our average lease term is about 3 years. And within the 3 years, we charge a base rent plus a percentage of turnover rent. And we track every tenant's sales religiously. So we actually know who does what sales, because their point of sales is linked to our system. On a daily basis, we know who does how much, are they doing well. When we run certain A&P activities, who benefits? Because when you bring in a teenage band, not everyone benefits.
Yes.
Maybe the F&B benefits, maybe McDonald's benefit. And when we run other programs, other people benefit. The point I'm trying to make is we look at sales as a very strong indicator. And once we know a tenant is doing well, we leave them alone. They can do their business on their own. Those that start to falter, we then go in, see whether we can work with them on marketing programs. And of course, if they can improve, fantastic. But if tenants that are not pulling their weight, not investing, not innovating, not changing, when the renewal term comes, we actually actively then manage them out, because then we have to bring in other stronger tenants to refresh the whole mall. So if you ask me, our weighted average 3-year lease term, but on the whole, when we renew each cycle, we deliberately try and change between 25 to 30%.
Really? Of those tenants?
Yes. But that is something that we may not want them to stay because they are not pulling their weight, rather than the other way around, where we are worried that they are going to pull out. Because a mall needs to evolve. I suppose the kind of business we run is a bit different from an industrial building or an office where you want people to lock in long-term leases.
Yes.
So that
there's very little innovation there, I guess, isn't there?
That's right. But for a retail mall, we want constant refreshment. But then we have to know who are doing well and who is not doing well. And the primary indicator for us is sales. So that's where we pride ourselves. We know tenant sales very well and precisely. Yeah.
Although that's very interesting, because I guess as a shopper, as a layman going into a shopping mall, you know, when you see a turnover of stores, you kind of wonder, is this mall doing well or not? Actually, what I'm hearing you say is that it's a sign of a very healthy mall to have that turnover. That might surprise people. Absolutely.
I think there was a recent report on Iron Orchard. Iron Orchard, I think, is doing very well from the day it started. 3 years ago, it entered the market. 3 years' time now, there's a chance for renewal. So I think there was some reporters that say there are a lot of hoardings. The mall may not be doing well. What you just pointed out is absolutely accurate, because the mall is doing very well. We're now in a good position to bring in even stronger tenants, and which is why every 3 years we have a chance to refresh the mall. We will then bring in 20-30% different type of tenants to change the mall, make it more relevant.
I assume, though, that you're not able to continually move the rents up. Presumably, you also need to take account of economic cycles. Sure. So to that end, the growth might come from additional malls. What sort of scope is there, actually? What sort of potential is there for malls, perhaps in the more mature markets like Japan? Because China and India, I guess we know that the growth is still quite substantial.
Sure. I think there are opportunities in every market that we are in. It's a question of whether, when the time comes, are you able to seize the opportunity. Just give you a good example would be CapitaMalls Trust bought Illuma in Bugis area in April 2010. If you go to Illuma now, you'll find that it has been rebranded as Bugis Plus. It's very vibrant.
Has that been completed, by the way? I think that was due to be done in July.
It is 99% completed.
Right.
And CapitaMalls Trust was able to buy it in April because the yield wasn't very, I would say, exciting, 3.8%, but it was able to buy at that kind of yield because it saw the opportunity to do upgrading. And they bought in April, started asset enhancement in November, and finished in July. Well, right now, if you go and see, you probably find that the whole place attracts a lot of youngsters now. 1.2 million traffic was recorded just last month. A lot of new brands have come in. The biggest Uniqlo store is on the ground floor in Bugis Plus, and lots of new to market brands. Laurie's Farm from Japan, a lot of exciting F&B outlets have sprouted out. There's Ireland's Potato, there's a best fried chicken from Korea called Bonchon Chicken. There is the famous curry rice from Japan called Koko Ichibanya. So lots of, that's what we do. We spot an opportunity, we have the confidence to do it, we execute it quickly, we bring in new tenants. Yeah.
If you had to, just finally, particularly for those people who have never invested before, if you had to concede any risks or downsides that come with investing in shopping mall owners generally or REITs in particular, what would you say people need to be aware of?
I think first, for investors, you need to understand your own risk appetite and risk profile. Well, if you are somebody who wants regular payout, low volatility, I would say better safety, then I think REITs is something that you should look at. Now, if your risk appetite is a little bit higher, perhaps looking into CapitaMalls Asia for the growth. But then for investment in CapitaMalls Asia, you need to have patience and a longer term view. So dividend is not probably the primary objective for investment. You need to look at capital appreciation as well. But if you, for example, are a pensioner or retiree and you want a regular payout, I think REITs would be whether it's CapitaMall Trust, Capital Retail China, CapitaMalls Malaysia Trust, I think that's something that you should look at.
And is there something that investors should know about for why property-related companies tend to trade at or below book value rather than the multiples of book value that we see with other companies?
Well, if you look at the REITs, CapitaMall Trust is trading at almost 20% premium. So I suppose the main thing would be the certainty of income, the steadiness and certainty of income probably gives that premium, plus the fact that the track record has been very good over the last 10 years. So I suppose that's where the premium comes in. Maybe the other thing that I can add would be for people who want to invest in perhaps CapitaMall Trust, you'll find that all the assets are publicly accessible. So when you get to a Junction 8 or you're in a Tampines Mall and you're in Bugis Junction, those are the assets owned by the REIT. You can actually feel the pulse of whether the business is doing well or not. So maybe that's something.
That familiarity.
Yes, that investors can take note of.
Very interesting. Thank you so much for coming in today.
Right.
Simon Ho, the Deputy Chief Executive of CapitaMalls Asia. Singapore Investment Week is the place to be if you're looking for more information on this and other investment opportunities. This is the website that you can go to for more information. It's on your screen now. And Singapore Investment Week is on from the 25th to the 31st of August.